7th of December. Let's just have a quick chat about some of the overnight news flow and some of the price action already seen this morning. And I think one of the most impressive things here is that these equity markets continue to kind of defy logic in a way in Europe, because we've continued to add to these gains that have been seen ever since the Italian referendum on Sunday night. Obviously, we had that strongest move seen at the opening of cash trade on Monday, and we've just continued to add to that. I mean, if you look at the closing levels of some of the Italian banks yesterday, I don't think you could have found one analyst on Wall Street that would have told you that the day after the referendum, or on the Tuesday after, that you would have UniCredit up 13%, Mediobanca up 10%, Milano up 9%. You know, they are incredibly volatile stocks, but I think it's still a really surprising reaction that this is continuing to punch higher. Quite interestingly, though, reading things like Jim Ree's Deutsche Bank morning note, much has been echoed from other economists, is that, you know, actually this move does defy logic to a certain extent, and it's difficult to really try and pin one specific reason why this keeps happening. But one of the biggest catalysts probably is a lot of it is short covering, i.e. a lot of those people who are expecting negative volatility are getting, you know, squeezed out of their positions given the phenomenal kind of recovery that we've had on Monday and Tuesday. I mean, looking at the euro currency, for example, certainly I think a bit of a short squeeze certainly attributed to that move that was seen throughout Monday morning. Also as well, I think still, as I was saying yesterday, I think the market comfortable with the fact, at least for the moment, Renzi is still in place. They'll look to take care of the ruling over their budget today, and then his resignation will be formalised either later this evening or Thursday. Then I think once the ECB passes and we go into next week, things might get a bit more interesting, given we'll be in a political limbo, if you like, in Italy specifically. But for the time being, equity markets still continuing to rally. Let's not forget as well, this is a day before the ECB are expected to add further accommodation in their monetary policy by extending their existing quantitative easing program as well. So you've got higher equities and higher bunds this morning though. So that kind of inverse relationship breaking down, and you're actually getting a bit of recovery from the move lower that we saw throughout the bulk of the session in yesterday's trade in regards to bunds, which trade up around 20 ticks. Again, correlation wise, it's a little bit messy, because although equities are on the front foot, you've got fixed income equities moving same direction, and gold is moving higher despite equities at around their highs. So again, this is what's making it a little bit tricky to trade when these correlations aren't moving in their most kind of natural form, I would say. So certainly I'd be a little bit more cautious when the market environment is like that. Particularly yesterday, which was a phenomenally quiet day overall. It's quite difficult, I guess, to remain disciplined in an environment like that. But like I was saying to, I think, the month 2 guys yesterday, you know, you do have the ECB meeting and regular press conference with Draghi tomorrow afternoon, so you're not going to be short of potential opportunity later in the week. So maybe just an extension of that kind of key rule of discipline, waiting for those more opportune moments to come later into the week. A couple things though to have a look at stories wise, and then we'll translate that into market prices. First of all, we've had some data this morning, the industrial production figure out of Germany. Nothing really drastically surprising. It was up 0.3%. This does tend to be an incredibly volatile data set, though. You can see here consistently every month it tends to fluctuate quite wildly, so I don't really think this is having much impact on market prices this morning. In fact, that number, if anything, was weaker than expected, so it hasn't really had much impact, because the euro is trading a little strong against the dollar, and the DAX, as I say, up at around its highs. As I say as well, DAX wise, technically, having seen this really strong rally after the Italian situation, we print highs as I speak. if I put it slightly longer dated, we're kind of breaking that resistance level of just above that 10,800 level, which has kind of defined much of the last few months, really from August, October and November highs. So that being broken is probably also giving this technically a bit of a further upside momentum to that move. Looking at other stories of note, obviously crude oil is one. Let me just, before I go into the actual article itself, let's just have a quick look at crude prices and where we trade at the moment. So obviously this was the 30th. This is that meeting that we had last week at the Vienna headquarters of OPEC. We rallied on that ability for them to piece together an agreement, 1.2 million cut with 600,000 coming from non-OPEC members, but the ability for them to have sort of settle agreements between the likes of Iraq, Iran and Saudi and Russia's input as well was met very positively, translating into market prices to the upside. However, yesterday we did have a bit of a pullback. We're sitting sub 51 this morning. One of the interesting things that came out yesterday was the oil retreating from that 16-month high I was just showing you, as OPEC are now pumping a all-time record amount of crude in the month of November, was the data we had yesterday. So going into the actual meeting, as a collection of oil-producing nations, they are now pumping at their most they've ever done. And so you've got to question the material impact of what the cut of 1.2 million is really going to have. Some of the growing consensus here is actually that OPEC is hoping that Russia will cut another 300,000 barrels beyond the 300 they've already promised. This graph just showing you here, this is the production values. You can see certainly over 2016 they've just been ramping it up across the board, and given the oversupply situation, the fact that I think that this cut will be somewhat immaterial to price, it's difficult to see on the supply side much positive factors coming in, but certainly with Trump and the administration's plan in the US of fiscal stimulus, and certainly the demand side could be supported. One of the other things here that I read in the upcoming talks to be aware of for today, Russia's Energy Minister Novak will meet oil companies today ahead of talks with OPEC representatives on December 10th, according to people with knowledge of the matter. So any oil traders, I would be a little bit cautious for headline news flow today specifically, because of those hints that you're getting from OPEC that they want Russia to potentially do a little bit more than the 300 they already promised in last week's meeting. And Russia's energy minister is meeting oil firms today ahead of those meetings in 3 days' time. So certainly just keep an eye on that situation. Elsewhere, you've also had the API crude oil inventories as per normal Tuesday evening. If I just quickly flick back to the chart, and you can see the actual reaction that we had last night. So let's find 9:30. Let me just circle the price action when the data came out was there. So in reaction to the APIs, actually a minor uptick, probably around 30 cents or so. Before then we pulled back in overnight trade. So initial reaction seems to have been based upon reacting to the headline crude number, which was a drawdown of 2.21 million. This is the second time that the drawdown has been larger than expectations. But the Cushing number was very large, a build of 4 million. Now, a lot of this might have been priced in. The Genscape number we get on Monday for Cushing specifically was a build of 3.35 million. So I think the market was expecting a large Cushing number, but 4 million is actually, as you can see here, the biggest weekly build in Cushing since 2008. You've also had a build of 828,000 gasoline and a large distillate plus 4 million as well. So although the market reacted a little bit more bullish on the first glance, actually we are trading a little lower than after those numbers came out now. In current trade, we're down 26 cents. So I'd say the Cushing number may just be drawing a bit more of the attention as Europe has come in this morning. So of course we'll get the API data later. That Cushing figure will be interesting to watch. A few other things just wanted to have a look at this morning. We've been talking about gold quite a bit because obviously gold has seen what many would view as a rather strange reaction, I guess, to the performance of the last couple of weeks from when Trump, that wick that you can see on this candlestick here, that was when you had the initial spike that Trump was going to get in, and then the kind of realization of what that meant for his kind of fiscal mandate and government spending, knock-on effects that could have, and as such then for future rate hikes and so on, and a firmer dollar. Gold's just been pushed lower. We broke some key levels, particularly around that 1250 to start, and then as we've got lower, 1200 was another key. You can see that from the low previously back in the summer, and then we continue to actually grind lower here, down to close to 1150. What the graphic here that I'm showing you is ETFs. So over the past month, exchange traded funds backed by precious metals saw a net outflow of $6.25 billion as gold prices have tumbled to a 10-month low. So you can see that here, just given some of the associated risks that we've had throughout 2016, obviously post-Brexit, the various political situations going into the US elections, the fear of another protest vote. Actually, gold was still being well supported, but now we've come out of that, and you can see here it's the biggest outflows we've had in a long time in terms of the money being removed from the market in post-election. Certainly here, looking at other assets, you can see here this is the MSCI World Index, so the equity index, the S&P 500. So you can see how we've had this continued strength in the equity market, and with the S&P still, well, actually if I get the S&P up, we are actually, you might as well call it, at the record high. The record high, of course, is 13 and 3/4 above that 2200 level. Obviously that was the previous all-time high, but we're up here again. That number that we're looking at on the 30th of November, that was supported obviously on those highs by that rocket higher in crude by over 10% on the OPEC meeting. That lifted the energy and gas stocks. That prompted the S&P to hit that fresh all-time record, and here we are right at that level again. But the higher these equity markets seem to go, the more or the less favourable gold or the appetite for gold seems to be, and you can see that really playing out post-Trump. Obviously there is still the associated risks though, and you can't get away from the fact that there's the possibility of a Trump-led trade war with China, uncertainties around the elections forthcoming in Europe, the still situation politically in Italy and as well as their banking sector, Brexit and so on. So there's definitely still a lot out there from a global macro perspective that could add uncertainty to market prices, but for the moment, as long as these equities continue to push higher, it seems as though gold will remain under pressure, at least for the time being. Moving on, the other big story to be aware of is for the British pound. Actually, just let's look at the price action from this morning so far, and we have had a bit of a pullback. If I put it on a slightly bigger chart for you, you can see that 128.06 was that key level we've spoken about before post-Brexit, and when the Tory had their press conference beginning of October. We'll talk about the flash crash in a minute, because some interesting news on that this morning. But we got up close to that 128.06, and then we started to reverse already this morning, and on the intraday session we're underperforming slightly in the cable pair, having already broken below the S1 level this morning. So it seems to be a Brexit focus still. Looking at the actual headlines, obviously it developed yesterday was this one. Theresa May on Tuesday bowed to pressure to set out her Brexit plans before triggering the Article 50 exit clause next year, as EU's chief negotiator Barnier set an October 2018 deadline for completing exit talks. Now this comes as she's accepted a Labour Party motion which will be debated in the House of Commons today, calling on the government to publish its plans for leaving the EU prior to triggering Article 50, so we'll be watching that later on this afternoon. Now one of the key interesting things here, and the thing that I just can't believe is going to happen in this period of time, is that realistically Europe has said they need at least 4 to 6 months for ratification by the UK and 27 national parliaments and European Parliament. So once a negotiation has happened and agreements have been made with Europe about the Brexit and what shape and form that will take, it does need to be ratified by all the other European parliaments. That's going to take, what Europe is saying, between 4 and 6 months. That actually means then that the negotiation period, once Article 50 is triggered, could actually in fact be as short as 15 months. Now let's face facts here. For the likes of Canada's trade agreements, Norway's and so on, this takes multiple years, getting close to a decade, and we're going to have to negotiate an entire European trade agreements across Eurozone members, and we've got to do it in 15 months possibly. That I think is an impossible task unless we get some kind of leniency on extension or a transitional period, of which you've probably read in the press. Actually trying to execute a full plan and new agreements across these countries in a 15 to 18 month period, I think is highly unlikely. And as such, maybe people just coming toward that fact as this continues to play out over the coming months, obviously ahead of the government's still definitive timeline of triggering the clause at the end of March. Now let's not forget as well, we are continuing to monitor the UK Supreme Court situation, and as we get in towards, I would say later this afternoon and definitely into Thursday, I would definitely be very sharp and vigilant for any journalist comments, breaking news, tweets about how this ruling may be heading. Obviously, as I've said before, I would say the consensus view is that the Supreme Court will just ratify what the UK High Court has said, that parliamentary officials reserve the right to comment on Article 50 and the Brexit process. Anything other than that, and we revert back to a more strong hand for the government, that would certainly be something which would weigh on the pound significantly. But already you're starting to see the government being forced to compromise and backtrack, I feel, especially now having to pander to the Labour Party's motion that they're debating today. And so maybe this is just explaining some of the softness just seen in sterling this morning. Just quickly though, to run off for the rest of the day, or run through the rest of the day, just something I wanted to quickly share with you was this article. First of all, just to refresh your memory, if I go back to the chart, the price action that I'm talking about, of course, was in fact the second largest intraday move ever in the sterling currency. That was this highlighted box or circle here. That was, of course, the infamous sterling flash crash that happened on the 7th of October. And the FT providing a bit of colour on that, and it's being pinned on a Japanese trading operations of Citigroup, who fired off repeated sell orders that exacerbated the pound's fall. So now, you know, they've carried out their investigations, a bit of mudslinging on who caused this. The Bank of England saying that actually upon further investigation, it looks as though that there was some actual traders instigating the move, whereas Citi themselves, of course, looking to distance themselves, saying that no, this was triggered by a fundamental reason, which was that FT story that contained various kind of Brexit type comments that triggered then algos to fire off. Some quite interesting read though, if you get a chance. I did tweet it from the Amplify account. People with knowledge of the event saying that Citi said that one of the US bank's traders placed multiple sell orders when the currency slumped in unusually fragile market conditions. Don't forget as well, it was extremely illiquid markets because China was closed for the Golden Week holiday, so there was hardly anyone on the other side of the trade. And then what this system is known as is an aggregated, basically, algo, which is then firing off sell orders across different exchanges, which kind of exacerbates then the order flow going through. So yeah, have a read of that. It's quite interesting, just from a, I guess not from a day-to-day going to move market prices now, but certainly if you're, you know, as an interest in that move, it's quite an interesting read. Moving swiftly on then for the calendar for the rest of today. UK data we got coming up in around 35 minutes time. That's going to be industrial and manufacturing production. A quick look at these. They've both, this is industrial production, you can see it's been fairly firm, but has been decreasing after that very strong recovery immediately post-Brexit. If you look at the manufacturing production, it has also had a fairly similar pattern. The one thing I'd want to be looking at in particular is the actual price pressures surrounding these particular industries. Because it's the inflation key, or it's inflation which is key to actually probably what the Bank of England are focusing on quite heavily, on how rapidly is this now fall that we've had, or dramatic fall over the summer of the pound, now feeding through into actual producer prices and net inflation overall in the UK. So keep an eye on that for sterling currency. That's coming up in around half an hour's time. This afternoon, fairly quiet actually in terms of US data, jobs, job openings, NISA GDP. I'd say it's not really too much of a big deal from the assets that you guys are looking at. You've got the Bank of Canada interest rate decision. Any of the live guys, if you're trading the CAD currency, that's always one that provides volatility, so definitely be looking out for that at 3 o'clock. And then you've got the Department of Energy's crude oil inventories to follow on from that highest Cushing build that we've had since 2008, so that will be the area of interest for that crude release. No speakers though to be aware of today, but obviously, as I say, keep an eye out and an ear to the ground for anything out of the Supreme Court hearing regarding the Brexit situation in the UK. Okay guys, going to leave it at that. So any questions as ever, just feel free to fire them into the chat room. Otherwise, enjoy your day. And as I say, I'll see you in the chat. Thank you.